Most business owners hear Augusta Rule and instantly think they found an easy way to pull tax-free money out. That reaction is exactly why this strategy gets abused, misunderstood, and turned into weak paperwork instead of real tax planning. The rule can be useful, but only when the meeting, the price, and the records all look normal and hold together. This is not a magic loophole, and it is definitely not a random rent payment you make up at year-end. It is a narrow tax rule that rewards clean facts and punishes lazy operators who try to shortcut the setup. That is why the first 20 seconds of this topic matter, because most people get sold the fantasy version. The fantasy version says you can rent your house to your business, write it off, and move on like nothing happened. The real version is slower, narrower, and a lot more dependent on business purpose than people want to admit. At the center of the rule is a simple idea that gets repeated everywhere and understood poorly by most owners. If a home is used as a residence and rented for fewer than 15 days during the tax year, people pay attention. They pay attention because the phrase sounds clean, efficient, and easy to weaponize inside a small business. But the tax language is not the hard part here, because the hard part is whether your actual facts deserve the result. The first real test is simple. Did your business actually need to use that property for a real business meeting? Not a fake meeting, not a lazy note on a calendar, and not a personal day rewritten later to sound more official. A durable setup starts with a business reason that would still make sense even if tax savings did not exist. Maybe you needed privacy, team planning space, partner discussion time, or a quiet place for owner-level decisions. If the business purpose feels thin, the whole structure starts losing credibility before pricing even enters the picture. Then comes the next place people get sloppy. They pick a rental rate that sounds exciting instead of defendable. That is where a smart idea starts turning into an aggressive story, and aggressive stories age badly under review. The right price has to feel normal for the area, the use case, the space, and the kind of meeting that happened. If the number looks inflated, the payment stops reading like rent and starts reading like extraction with paperwork. That is why fair market support matters more than enthusiasm, because enthusiasm is not what carries this strategy. Then comes the part most owners underestimate even more than pricing, and that is documentation. A strong Augusta Rule file needs a real meeting date, a real agenda, and a real list of who attended. It also needs support for how the rental rate was determined and records showing the business actually paid it. Because tax strategy does not survive on memory, and it definitely does not survive on vibes. Shortcuts usually do not break in theory first. They break in missing notes, vague purpose, and weak payment trails. That is why messy operators should not start here, even if the headline version of the rule sounds attractive. This works better as a later move for owners who already run cleaner books and more disciplined systems. If payroll is already sloppy, reimbursements are messy, and records are inconsistent, this adds more risk than value. The right sequence is business need first, price support second, documentation third, and tax result last. That order matters because once people chase the outcome first, they start reverse engineering facts to fit the payment. And reverse engineered facts are exactly what make a legal strategy start looking fragile and convenient. Used well, the Augusta Rule can be a legitimate part of owner tax planning inside a real operating business. Used lazily, it becomes one more file full of weak support, inflated numbers, and avoidable tax risk. The goal is not tax-free rent. The goal is a clean, defendable business process.